one of the underlying stories out there remains whether the dollar is about to enter a bear trend. So in equity markets, the definition of a bear trend is a 20% fall from its highs. That classification would mean a major and exceptional move in FX markets, since the dollar has only fallen more than 20% on 2 occasions over the last 40 years. This shows a big dollar decline seen in the mid-1980s and also then in the 2002 to 2008 window. If we do see the kind of 15% decline, I think we'll probably see it for one of 2 reasons. The first is a kind of benign dollar decline we've seen in periods over the last 20 years, characterised by synchronised global recoveries, rising trade volumes and flows into emerging markets. A sharp recovery in world trade volumes seems unlikely this year, but reflationary Fed policy should prove supportive for risk assets. And our preference is that will be enough to drive the dollar around 7% weaker this year. The second path to a dollar decline is a more negative one. Here the narrative would run along the lines of international investors refusing to finance the US budget and current account deficits at the same price, i.e. they would need a cheaper dollar to continue to do so. You can see that story here in this chart. We've got twin deficits going back to 1990. You can see over the last 20 or so years, particularly the big deficits in the late 2000s, how the dollar was under pressure. This second path seems the less likely path for a dollar decline. You could say that a close US election potentially plays a role here in September by inserting a greater risk premium to US asset markets, and we're certainly going to look out for that. In the background, there will always be discussions about the end of dollar hegemony, but these are longer term considerations, and just talking over the next 6 months, our preference does remain for the benign dollar decline path.